Chapter 3, Part 3, Accounting and Finance. Having gone through aspects of how to create balance sheet, income statement, common size balance sheet, common size income statement, and understanding different attributes of balance sheet such as market value and book value balance sheet, and understanding the power of comparing common size income statements across different firms, after going through this presentation, student will be able to deduce the statement of cash flows, analyze corporate and personal tax rates, and be able to deduce marginal and average tax rates. Let's go back to that example of starting a coffee shop. So we started a coffee shop with a cash of $700, and you saw the effect of that on the balance sheet. Total assets went up to 700, total liabilities and owner's equity was at 700. The effect of income statement was nothing because we did not make a sales. When we bought new machine for $500, we spent cash, so we had a cash outflow. In other words, there was an investing activity. We created an investment of plant and machine for $500, which led to a decrease in cash, but no effect on the total balance sheet size or total assets. So the balance sheet was still balanced, and there was no effect on income statement because we didn't make a sales. Next, when we bought raw material on credit, we saw that the total size of the balance sheet expanded by the value of raw materials because our accounts payable increased. So now the new size of balance sheet or total assets was 800, but we did not make a sale, so there was no effect on income statement. When we manufactured 10 coffees using 10% of the raw material, our finished goods increased to 10, raw material decreased to 90 from 100, but the balance sheet remained the same. We still had no effect on the income statement because we did not make sales. When we sold that 10% of material for $25, then we finally saw that finished goods became zero, but accounts receivable increased to 25, and our balance sheet totally expanded to $815. So there's a $15 gain in owner's equity because of the profit. The effect of all this on income statement was we made a sales for 25, cost of goods sold was 10, and profits was 15. Notice the important part here is sales was on credit, cost of goods sold was on credit, and the profits essentially were non-cash, but they're still profits. So what is the difference between profits and cash flow? And what do investors and shareholders really value more? So the difference between profits and cash flow essentially is profits are associated with the margin that a company makes after they sell their goods and services. And cash flow, as we saw while acquiring plant and machine, or as we saw when we were raising fresh money for the coffee shop of $700, are not related with profits really. They could be directly related when we make a sales and earn profits. But cash flow is much more broad as compared to profit. And so there are other things which are also associated with making a sales, such as depreciation and amortization and other non-cash expenses which are attributable to income statement but are not cash. So it kind of underscores the importance of why cash flow is important for an organization and why investors do lay a lot of stress on cash flow statement. So when sales increase, cash flow increases. Now these are operating cash flows. When cost of goods sold is greater, our cash flow is lesser. When inventories go up, all else constant, cash flow decreases because we bought them. When accounts receivable decrease, that means somebody has paid off our loans, cash flow will increase. When accounts payable decrease, that means we paid off our own accounts payable, our cash flow will go down. So the relationship between sales and cash flow is positive, directly proportional. The relationship between cost of goods sold and cash flow is inverse. The relationship between inventories and cash flow is inverse. The relationship between accounts receivable and cash flow is inverse, and accounts payable and cash flow is direct. So we can say cash flow is a sum of directly proportional sales, inversely proportional cost of goods sold, inversely proportional change in accounts receivable, directly proportional change in accounts payable. Now let's look at our activities for the coffee shop on a time frame number line and see the effect of cash flow as we were doing it. So initially we acquired raw material. Now these are operating cash flow. Remember, there was a financing cash flow and an investing cash flow. The financing cash flow was how we obtained the $700 for setting up the coffee shop. The investing cash flow was a $500 that we used for buying plant and machine. Now here we're talking about operating cash flow. When we bought $100 of raw material, our cash flow should have decreased, but our accounts payable increased. So, but in this case, let's assume we bought raw material in cash. So if we bought raw material in cash, our cash would go down by 100. When we converted that raw material to finished goods, our cash flow didn't change because we really didn't spend any cash. So assuming electricity and overheads and other operating costs was zero for simplicity. Next, when we sold these as finished goods but no cash was received, when we made a credit sale, the effect on cash was still zero. That's because although we made plus 25 of sales, our accounts receivable also increased by 25, so minus of that plus 25. So 25 minus of plus 25 is 0. This 0. Last period, we received the $25 cash, which means although we made no sales, our accounts receivable dropped by 25. So minus of the minus 25 is plus 25. So this is the minus of minus 25, and the above here is a plus 25. So the only difference here from what we actually did with the coffee shop was we acquired raw material in cash. There was no other difference. Now moving on, cash flow increases because sales increases, because cost of goods sold could decrease, because inventories could decrease when we make a sale, because accounts receivable decreases and accounts payable increases. So the proportionality is direct, inverse and direct for accounts receivable and accounts payable. On the other hand, if cash flow decreases, it could be because of lower sales or higher cost of goods sold or increase in inventories or increase in accounts receivable or decrease in accounts payable. So that's the negative cash flows. And to put it all together, this is how it looks. We just talked about this in separate tables. Now we've combined them all to put it to one table. Notice how the proportionality is direct, inverse, 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 and direct. Okay, let's take an example for a coffee shop. So in the first period, we bought new inventories and the effect was negative 100. Again, I'm just repeating that same example that we saw number line in a table. In the second period, we just converted those inventories to finished goods, no change in cash flow. In the third period, we had sales, accounts receivable went up, cost of goods sold was 10, but also a decrease in inventories. So the net change is 25 minus 25 minus 10 plus 10 is 0. There was no cash transacted at all. Lastly, now we have accounts receivable going down, so minus of minus 25 is plus 25. So net to net over these 4 periods, our cash change was minus 100 plus 25 or minus 75. If we put together the investing and financing activities, then that would be another minus 500 plus 700, so plus 200. So plus 200 minus 75 is plus 125, our cash situation. Okay, only the firm's cash receipts and cash payments are accounted for in the cash flow statement. So cash or free cash flow is available for distribution to shareholders, new investments or expanding activities by the firm to provide more liquidity in the future periods. And to move on to the statement of cash flow, to summarize, cash flow is generated from operating activities, which we saw in detail in the previous couple of slides, but also from investing activities and financing activities. So the ending balance in cash on the balance sheet is a beginning balance in cash from on the balance sheet in the previous period plus cash flow from operations plus cash flow from investing activities plus cash flow from financing activities. Now here's another example. Let's assume that MKZ Airlines earned a profit of $4,767 last year. The depreciation or non-cash expense was $2,581. accounts receivable increased by 540, accounts payable increased by 1626, and inventories and short-term investments increased by 52 total. What was the total cash flow from operations? So we can see inventories and investments must have decreased cash. Accounts payable increasing would have increased cash. Accounts receivable increasing would have decreased cash. And profit would have obviously increased cash. So depreciation would have also increased cash. So net income plus depreciation plus minus accounts receivable plus accounts payable minus change in inventories and short-term investments is the total answer of cash flow from operations of 8382. So this is summarizing what we learned in the previous chart about the effect of other things on cash flow from operations. Now let's talk about corporate taxation a little bit. In the United States, corporations pay a tax on their income, and this tax rate is flat 21%. So for example, if a firm earns income of 44,000, the 21% of if a firm earns an income of 44,000, 21% of 44,000. Let's just confirm that using a calculator here. So 0.21 times 44,000 is 9240. There we go. So $9240 is 21% of $44,000. Now, if the taxable income was 70,000, then it's just 21% of 70,000, or 14,700. Next, in the case of personal taxes, it is divided. The tax rate is divided into different slabs. Let's just focus on single person filing a tax. If their income is 11,000 or less, they don't pay a tax. If their income is more than 11,000, they'll pay 10% on every dollar earned over and above the 11,000. If their income is over and above the 11,000. If their income is let's say between 11,000 and 44,725, they'll pay a tax rate of 12% on any money earned above 11,000, and so on and so forth. So this goes on until $578,125 of income, over which they'll pay a tax of 37%. So if the taxable income is so below 11,000, it should be 10%. Apologies on that typo here. So it should be less than 11,000. The tax rate is 10%. Okay, moving on. So the taxable income is 44,000. On the first 11,000, they'll pay a tax rate of 10%, or $1,100. The 10% is called marginal tax rate. Between 11,000 and 44,000, that is the next $33,000, they'll pay a tax rate of 12%. So 12% of 33,000 is 3,960. So this is a marginal tax rate of 12%. So the same individual is paying two different marginal tax rates, and the total tax obligation would be therefore 3,960. That 3,960 plus that 1,100, or 5060. Now, if the income was $70,000, they'll pay 10% on the first 11,000. 12% on the next 33,725, and 22% on the remaining 25,275. So the marginal tax rates are respectively 10%, 12%, and 22%. So the total tax obligation would be 10707.5, correct. And the way we calculate average taxes, so as we saw, marginal tax rate was a tax rate applicable to each bracket. The average tax rate is the average rate paid on that particular income, and it changes. So just like, because each individual faces a different marginal tax rate based on their income, they will have to pay a different average tax. So on an average, the first taxpayer paid 5060 divided by 44,000 times 100 on an average tax rate of 11.5%. The second individual, who earned $70,000, paid an average tax of 5560 on a the tax was not 5560, it was 10707.5 on a income of 70,000. So 10707.5 divided by 70,000 times 100, which is a tax rate, average tax rate of 15.3%. And to conclude, we saw the effects, or we created the balance sheet, we created the income statement, we created common size balance sheet, common size income statement. We could compare across two different firms using common size balance sheet and common size income statement. So common size balance sheet was a base of total assets. So it's a percent of total assets. In common size income statement, every item is a percent of total revenue. Income statement is obviously created using firm's business activities. Unlike the cash flow statement, which is any change in any investing activity, financing activity, or operating activity will create cash flows. The common size income statement was a percentage of total sales. In the cash flow statement, the most important component for operating cash is sales minus cost of goods sold and any change in accounts payable and receivable and inventory. Finally, tax rates have two different features. One is the marginal tax rate, or the tax rate applicable to each slab, and the average tax rate, which is the average burden of tax payable on that particular income. We also saw the difference between personal and corporate tax rates, and we noticed that the corporations have a flat tax rate of 21%, which makes the accounting department's life relatively that much more simple as compared to personal income taxes. And that is Chapter 3, Part 3. Thank you for listening.